Hi, I'm Toby.
And I'm Nick.
And welcome to the Pure Property Podcast from Track Capital, where we talk about all things property and property investment. The aim of the podcast is to give you bite-sized chunks of our industry insight and knowledge to help you invest intelligently. Today, obviously, we've had the Chancellor's budget announcement not so long ago. Isn't that correct, Nick?
Yes, yeah, exactly. It seems to be these days that a lot of the government initiatives are kind of leaked before they officially are announced. So we did have a sort of rough idea of what to expect. And in terms of the property market, it was pretty much in line. So the stamp duty holiday has been extended to June. That, for those that don't know, provides the exemption up to 500k on purchases. So basically minimises your stamp duty exposure, and they are extending that to June, and then beyond June for a further 3 months after. They're also putting that exemption down to 250k, but obviously still leaving 250k that purchasers won't have to pay stamp on. So yeah, that was really positive, and I'm sure a lot of people will be happy about that, especially with all the transactions that are going through at the moment, where a lot of people were potentially waiting to see if they were going to be hit with the bill, which they weren't first expecting. So yeah, that was a big one. Obviously, we had the mortgage guarantee as well, the announcement of the scheme. I think they're effectively underwriting mortgages so we can get those deposit levels down to as low as 5%. And then there was all sorts of other bits about the VAT, furlough being extended, corporation tax rising as well to 25%. I think in the 2023 that was. So yeah, plenty of bits and bobs, but overall, really positive for the UK property market and for the UK in general. I think again these government initiatives, no matter what you may think of the government itself, they are extremely generous compared to sort of the other countries out there. So yeah, all positive, and hopefully we roll on with the vaccine rollout, and then we're in a stronger position going forward.
Yeah, and I think just touching on one of those points, a catalyst for the market, I think, is going to be sort of very big, is going to be the mortgage guarantee. So obviously we have to see how the setup's going to be and how strict the lender's going to be. But if that does start being accessed and used by a lot of buyers, that's definitely going to open up the market and flooding some extra buyers. And that's only going to increase demand. Now, I think you're going to see that definitely take shape and affect the southeast and around London areas where the affordability levels are tough and where a lot more buyers have struggled to get onto the market. So I think that's definitely going to be a boost in those areas, which have been probably the most sort of hit in a sense with the coronavirus and with the affordability levels being tougher. But we're definitely going to see that up north. And the best example you can give of that is the Help to Buy scheme, because that's exactly what the Help to Buy scheme did, but only with new builds. So what that did essentially is any of these new build schemes that were being developed and offering the Help to Buy, it was immediately pushing up the prices because they were just more accessible to buyers. And then that spread and rippled out to surrounding properties. So I think that's definitely going to help the property market. It's going to keep it going. And I think it's going to put an upward trend on prices. But who knows? We'll see once the finer details come out.
Yeah, exactly. I mean, I do agree with you. I think where this one may be slightly different as well is that it's not on the product side, and by that I mean that the developments themselves are not going to be categorized as this is for the 5% mortgage scheme, etc. So what we saw with Help to Buy is some developers inflating the prices because they knew that obviously people wanted to buy them and they're somewhat restricted. So yeah, we won't go into too much detail, but yeah, exciting stuff ahead and waiting to see how it all pans out. So what's the subject for today then, Toby?
So yeah, we're actually taking a pessimistic view this week, and we're going to be talking about the risks of property investing. Now, as a property investment company, you're probably quite surprised that this is a subject we are going to be talking about. However, it is something that we do, I wouldn't say enjoy talking about, because that obviously it can be perceived as quite negative. However, it's something that we do talk about with investors because we think it's very important to highlight the risks involved with property investing, because some others may not deem it a appropriate to talk about the risks straight away or sort of openly, just because it could be detrimental to somebody buying a property. However, we find it very important here to highlight those. So if you are going into an investment, you know the potential risks and pitfalls. So if they do on the rare occasion happen, that you can be prepared for them, and you can be comfortable going into an investment knowing those. As we always say, with any investment, whether that's property or anything else, there is always a risk involved. So the main thing is about knowing those risks and trying to mitigate those risks as much as possible.
Exactly. Yeah. So really interesting topic. And sometimes, people do ask us directly, what are the cons of this investment, or what are the risks associated? So hopefully today we'll go through the factors and give everyone a really broad idea of, what to look for, what's in your control, and then also other bits and bobs that may not be in your control. But the idea is just to ensure that everyone has a good understanding of the potential risks, whether those are in your control or not in your control. So you guys can ultimately make informed decisions. And obviously the developments that we work with specifically, we take these factors into account as well. So, okay, let's move on to the first one then. This is focusing on a couple of pre-purchase points to consider around the risks of property investment. First one being location. So it's probably quite a simple one. Everyone normally has a rough idea of where they want to buy or in the region they may want to be focusing on. But where we wanted to stress the focus being today is really being hyper local and doing extra research and due diligence into the location you might be buying. So not just looking, is there a train station nearby, but also looking at obviously transport links, the reputation of the area in general. Is it a bit more affluent, or is it at the more lower end? What's the crime rate? Is there persistent, antisocial behaviour in the area? A good reflection of this will be the schools. What's the quality of the schools? And all these bits and bobs can obviously affect the tenant demand and the resale demand as well from future buyers. So yeah, the long and short of it is, yes, we probably have a rough idea of where we want to buy, but our advice is to be really granular and look, street by street, and be hyper focused on your research in terms of the location, potential risk, or any changes that may be on the horizon.
Yeah, great point there. The next one we will go over pre-purchase, mortgages. So firstly, getting one, that will be a risk. So you have to make sure, and we always make sure that investors have spoken to or planning to speak to a mortgage broker before they commit to any investment. Just because once you obviously put that reservation fee down, if you're unable to get a mortgage, then you lose the reservation fee. And if you're buying off plan and you've exchanged and completion is a little way off and you're unable to get a mortgage, that's obviously going to cost you your deposits on exchange. So getting a mortgage is a risk that you have to take into consideration. So we always recommend speak to a broker, preferably one with access to the open market, and that should sort of help mitigate the risk of that happening, because you'll know potentially, one, that you can get a mortgage, and two, if you've already outlined the development, you can present that to the broker. They should be able to give you a good idea on whether they'll be able to source a mortgage for that property. Interest rates. So on a mortgage, usually our investors doing interest only. This is something you have to be aware of because they can go up. So you may secure a 2-year fixed, 5-year fixed, or you may go on a variable rate at this moment in time. And they are very favourable and appealing rates at the moment. However, that can go up. So that's something you have to bear in mind and factor in. The good thing about a mortgage as well, a mortgage company will stress test this to an extent as well. So they're not going to lend to you on the basis where if interest rates went up quite a bit, you would struggle to pay the mortgage. So again, quite a good thing about getting a mortgage is the lender will do some form of due diligence for you in terms of affordability and being able to pay that mortgage and rent that property out and still make a bit of a profit. Down valuations. Something we have seen during the course of the coronavirus pandemic, where surveyors have been a lot more stricter. They've had a lot more pressure to be strict because they've been worried about potentially prices dropping. We haven't seen that happen, and it hasn't happened, so that's good. They will be under pressure from lenders to be very strict on their valuations, because lenders are obviously putting up the majority of the risk by lending you the predominant amount on that property. on average, sort of 70% they'll be putting in, and you'll be putting the other 30%. So that means they are being very strict on their valuations, and that has led to a few down valuations. I've had a few investors on some projects, none to do with us, fortunately, but they've had a couple of down valuations where lenders have been a bit stricter. So something you do have to bear in mind, because if it is down valued and you still want to buy the property, then you have to make up that shortfall, of course. Mortgage markets. So mortgage markets can change. The products available today may not be available tomorrow. So if you are buying off plan, again, something that you do need to consider is when you speak to your broker and you get an idea on the products and the rates you'll be looking at, that can change by the time the development is complete. So as long as you bear that in mind and you are prepared for that, that's absolutely fine. Crystal ball is obviously excellent to have, and I'd love to sit here and say it definitely won't happen, but normally it doesn't happen. But if it does, just something that you would have to be aware of, as that is a risk. Over leveraging. Now, we mentioned this, but it's not something you can really do anyway, because again, mortgage companies don't allow it. The average you'll be looking at is around 70% loan to value. You can get 75%. Pre-coronavirus pandemic, we did have 80% loan to values, and some may say that was getting close to over leveraging. And we say over leveraging is a risk because, let's say, for argument's sake, the 5% deposit scheme that the government's announced was accessible to investors. Great, happy days. Investors only have to put in 5%. However, the risk for that is if the property market, for some strange reason, was to drop more than 5%, you're technically in negative equity. And this is what we saw happen in the financial crash and led to a lot of properties being given back to the bank and recalled in. So again, something you do have to bear in mind. But as I said, you are protected because most mortgage products and lenders, they don't allow you to do that. You aren't able to do that at the moment. The other risk or thing that you have to factor is having a contingency plan to pay the mortgage when the property is vacant. So just remember, when you first pick up the keys, you're not in every circumstance, or a lot of circumstances, unless you buy with tenant in residence, you're not going to have a tenant waiting to go straight in. There may be a situation where that can happen, but not all the time. So you may have a couple of weeks, maybe a month, maybe 2 months, depending on the area that you're looking, where you may be vacant. You also, when a tenant moves out, may have a vacancy/void period where there's no rental income. So you have to make sure that you have a contingency in that scenario. So I always recommend having a pot to the side to keep that at bay and minimize that risk as much as possible. And also, the main risk overall that you have to factor in is that it is a debt. So you are in debt to the lender, to the bank, whoever it may be. If there's any scenario where that goes wrong, you are liable for that debt. So again, that is a risk that you have to bear in mind.
Good stuff. So yeah, obviously there was a lot of detail there, and it was quite catered to the investment market as well. So just bear in mind that may obviously vary slightly in terms of the figures that were mentioned for a residential purchase. So it does vary slightly. How we can sort of mitigate and make sure that we're making responsible decisions when it comes to lending is working with a quality broker. So if anyone does need to speak to a mortgage broker, let us know. We've got a couple that we work with who are really good. But yeah, there's some really interesting points there. Some in our control, some out of our control. But obviously the mortgage and the financial process is a big part of property investment. So getting it right can reap rewards. So moving on to the next one then. This is, again, pre-purchase. And when we're analysing investments, what sort of things we want to look for and what are the risks involved. And one of those categories would be financials. So the first one being sort of overpaying for a property is a potential risk. So might seem an obvious one, but actually, if someone's doing a really good job of selling you a property and marketing a property, they might focus on other things like the location, the demand in the area, the regeneration, the employers nearby. There's 101 things that they could focus on other than the bottom line price. So just bear in mind, make sure you're doing your research, whether that's speaking to the competitors or other agents in the local area, doing your own desktop research online and Rightmove, Zoopla, etc., and just making sure you're getting fair market value. Do bear in mind just a couple of bits on the investment side is that some new builds, some people will be aware, some new builds may be overpriced slightly, depending on the developer, the demand, the timeframes of the project, i.e. how close it is to completion. So we've just got to make sure it's a fair rate in line with other comparable new builds. And then the other thing that we do sometimes see, or not so much these days, but used to see, is the prices being inflated when there's a rental assurance offered by a developer. Now, I won't go into too much detail now, but in a lot of products, you do see assured rents and contractually guaranteed returns offered by the developers. And sometimes this can be reflected in the purchase price. So we just want to make sure that we're buying something that's reasonable and fair. So overpaying is certainly some form of risk that's there when we're making our decisions. Another more risk on a ongoing day-to-day basis would be that the rental income might not be what you expected at the start. So again, it's just a case of doing your research, checking online, speaking to agents, being hands-on and making sure that our rental figures are accurate, and any projections you're relying on are likely to materialize in real life as well. So that will make sure you've got a nice, comfortable cushion there. If you are leveraging with finance, that you're easily covered, or if you're relying on the income to live as a pension income, etc., you're going to have enough funds there. So that's a really important one. In terms of the ongoing charges, service charges are one that you'll see on all new build developments. Now, service charges, they're typically priced per square foot. As in £2 per square foot, for example, and then you'll get a yearly figure or bill that you'd have to pay. And now service charges, they can fluctuate slightly, especially when a development is new to the market. It takes normally a year or two for a development to be absorbed and to work out what the specific charges are within the service charge budget, but that can vary slightly. And then just finally, the ground rent, which is something we see on leasehold properties. So it should be set at about 0.1% of the purchase price, and it should only be able to increase every 10 years in line with inflation or RPI. So it prohibits any sudden increases. So that's something we want to keep an eye out before. But yeah, definitely another factor we want to consider is the general finances. So overpaying, ensuring accurate rental projections, and then our ongoing charges such as service and ground rent. We want to make sure they're in check as well. So hopefully that gives a good overview. So moving on to sort of post-purchase, what's the next one then, Toby?
So post-purchase, we'll be looking at an investment point of view with tenants. So up there at number one is tenants not paying. So chasing these arrears and tenants not paying is very frustrating and one of the most negative parts of renting a property out. However, if you've got a good letting agent, management company, they should take care of that process for you, and they should be able to follow the protocols and correct legal routes to go down the eviction route if needed. And you just have to bear in mind that evicting a tenant, getting a tenant out if they're not paying and trying to get the money back can be very long-winded, and there's not always the assurance that you will get the arrears back in the end. But not paying is a risk that you do have to consider, and this can be mitigated by picking properties in the right areas where you're going to get a good tenant demographic, this is less likely potentially to happen with. Again, there's no guarantee with that. One way that you can help mitigate this and one way you can mitigate this is by actually taking out an insurance product where you can be covered for rent arrears and a tenant not paying. The next we're going to look at when we're looking at tenants and the risks is them damaging the property, which again, as long as you've got deposits in place, you should be covered for sort of minimal and small damages, as you can take that out of the deposit. However, sometimes they may cause large damage, and this will be something that will have to come out of your pocket. Again, there are insurance products where you could be covered in these instances, but predominantly it's a risk you have to consider, and you may have a pot put aside just in case that may happen. Then we look at void periods and just renting the property out in general. So you have to be aware, as we've previously mentioned with the mortgage side, that there can be void periods. This could be at the beginning when you first get the keys, and between tenancies as well. And renting the property out, that's where you're going to obviously find the void periods. But as long as you're organised, if you're really on the ball, you've got a proactive managing agent or letting agent, this can be reduced quite a lot.
Good stuff. Yeah, and just to add to that as well, I think one thing that really, really helps a lot of people is stringent reference checks by the management company. You know, if we're really looking into our tenants, if we're aiming for the young professional market with stable jobs, etc., hopefully that will enable us to minimise any potential stress or issues that occur further down the line. So, moving on to the next one, legislation, regulation, and taxation. Not something that most people have in depth knowledge of, but it is something that we do have to consider. Whilst some of it may be in our control, some of it, or most of it, should I say, is not actually in our control. But just a couple of points to think about. Extra paperwork and documentation can cause issues or delays in a purchase process. So, for example, cladding issues, you now need the EWS1 form, so external fire review, signed off by a solicitor during the purchase process, which can cause issues in some cases. Mortgage rate relief is obviously changed with what's called Section 24. So it removes the landlord's ability to deduct their mortgage interest payments, and as a result, the tax charges are higher. We've obviously got stamp duty fluctuations going up and down. We've had corporation rate tax changes today as well, which will probably only affect the larger scale landlords and investors. But yeah, the long and short of it is, you know, bits and bobs are changing consistently. So we just got to try and stay on the ball. And a decent management company should always inform you of what's happening and what your obligations are as well, especially if you've got properties such as HMOs. So if you're renting a property on a room by room basis, there's typically a lot more regulation. So you've got to make sure the fire equipment is on point. You've got fire doors. You've got to make sure your license is relevant and updated, etc. So there can be a bit of a headache and a bit of a risk with regulations and taxes changing, etc. So we just got to make sure we're on the ball, keeping an eye on the market, or speaking to your, your property manager or an investment agent you've got a good relationship with, etc., etc. So, yep, cracking on with the next one then, Toby.
Yes, market changes. So the first one of this is obviously going to be prices. There may be some investors that have been in the property market maybe only a few years, and they may think that by the looks of things, property prices only go up because that's what predominantly they have been doing. However, that is not always the case. You would have heard me and Nick discuss before about the 18-year property cycle, and if you are aware of this and know about it, you will know that at some points there are dips in the property market and property prices. So just be aware that at some point prices may go down. So the price you buy at today, if the property prices drop tomorrow, obviously it will be worth less money. So that is a risk. However, if you are looking long term at property, we do know that prices always come back up and surpass where they were previously. Hence us mentioning the 18-year property cycle. So although that is a risk and something that you definitely do have to bear in mind if you are looking at long term, that risk is mitigated in some shape or form. The other market change that we do have to consider as a risk is demand. Demand can change. Again, we've seen this as an example recently in London. Demand has gone down, supply has gone up, and this has caused prices to have a slight dip. So just something you have to bear in mind where you're buying and in the market that you're buying. Demand can change. It may be really high at the moment, but it may go down. As long as you're proactive again and on the ball, picking sort of as solid an investment as possible in a location which has got high demand and has a proven track record of that, you should mitigate that as much as possible, but it is still something definitely that you do have to consider as a risk in the future.
Definitely. And just looking at the price side of things and the capital growth, just to give everyone a very quick snapshot of the top 20 cities in the UK, the 20 largest cities, in the 12 months to January 2021, there was only one city which had negative performance, so -2% based on the previous 12 months. So the rest of the cities were performing exceptionally well. The lowest was Cambridge at 1.5% growth, and the highest was Liverpool at 6.8% growth. So, yeah, still very, very steady markets, something we expect to see going forward. Just before the final point, developer risk. So, big one for us. We're very heavily focused on the off-plan market and the new build side of things. So a lot of our investors are asking questions around the risk profile of the developer, the track record, security that's in place on deposits, etc., etc. But a couple of the risks would be the developer going bust, i.e., during the build, and then if there is a rental assurance, i.e., a contractually guaranteed rent, the likelihood of that developer paying that as well. So we want to make sure we are buying with deposit protection if we can. If we're buying from a developer with a strong track record, that's always positive as well. And then also just on the rental assurance bit, we want to make sure that we're purchasing properties with that would perform well without a rental assurance. So what's the underpinning performance of the asset? Does it produce a strong net rental return without the rental assurance in place? So that's a couple of things, a couple of pointers how we can mitigate the risk there. But ultimately, it is a risk if you're purchasing off plan. And along with that, hand in hand comes delays in build. We did see a couple of knock-ons from especially the first lockdown last year. A lot of the bigger developers, Barclays, Taylor, Wimpey's, etc., they weren't forced to stop, but to protect their image, they did stop on-site construction for a while. And as a lot of the small and medium-sized developers followed suit, but following the second lockdown, the government said it was fine for people for construction to continue on site. So luckily, there hasn't been too much disruption since then. But yeah, ultimately, you can expect some delays on a few projects from which are during the construction process last year. Just a few pointers on that as well. When you are buying off plan, no matter what anyone tells you, you should always have a bit of leeway on your completion date. As we've seen, unforeseen circumstances can occur. And no matter what anyone tells you, whether it's a developer, whether it's someone else that's bought in the scheme, whether it's an investment company or a local estate agent, no one can always be 100% sure of what's going to happen. So yeah, always a bit of leeway should be expected on the build timeframes. And obviously, if you're buying a development that has interest on the deposit, that's always a nice incentive as well for the developer to finish promptly. And it just means that if they do go overboard a bit, then you have the initial bonus of a larger discount effectively from that interest which is accrued during the construction period. And just lastly, there's always a risk if you're buying off plan and with developers directly that the final product may be not where we want it to be. Obviously, we do have an extensive snagging process with developers, so we can go and check that out and make sure it's all up to scratch. You've obviously got the new build warranty there as well. So yeah, I mean, ideally we want to go for a developer that's got a finished product we can look at. But yeah, build quality is always something to keep an eye on. But as long as we've got a building warranty in place and then we go and do a really thorough handover and snagging process on practical completion, then you should be all set.
Excellent. Great points there, Nick. Lastly, we're going to look at advice and what I always cover, analysis paralysis.
You do love that one, don't you?
I do love that. It's one of my favourites. But yeah, so advice, bad and wrong advice. So this is a major risk if you are speaking to a property investment company, if you're speaking to an estate agent, anybody other than yourself who's not the purchaser and you're taking advice from, you have to be very careful because you can get bad and wrong advice. So investment companies obviously make sure that they are giving you the whole picture and make sure whatever research and due diligence they present to you, you do your own due diligence on that as well. We always present as much information as we can to our investors, but we also encourage them to double check that and do their own due diligence as well, because it's all good us presenting them our due diligence and also what the developer has provided. But unless they look into themselves, how can they be 100% sure that it all stacks up? And there is many simple ways to do that. And if you do want to know how to, please get in touch with us. We're always happy to help. The wrong and bad advice can be very, very costly. And that's not just from investment companies or estate agents or anything like that. That could be your mate at the pub who sits next to you and says, "Oh, I've got a great investment. You only got to put this in and I can guarantee you'll get this much money. Oh yeah, my mate says it's good as well." Just anything like that. Always research. I can't hammer home that strongly enough. It's very important because, as I said, bad and wrong advice can be very, very costly. And again, if you don't look into it yourself, how can you naturally be 100% sure and confident of what you're going into? So, yeah, just something I recommend doing. Be very wary of bad and wrong advice. But on the other side, analysis paralysis. So, you can sometimes look into investments and scenarios too much, which then just leads you to doing the worst thing, and that's nothing. So there's always going to be another deal out there, another development, another property, another area, another something. There's always going to be something going on which can distract you. If you're always looking at that something else and never committing, all you're doing is exactly that, not committing and missing out on other opportunities. It is very difficult and it's a big thing to commit to, and I get that, and that's why you could be easily distracted thinking, oh, what if that's better? But look, as I always say, you're never going to get the 100% perfect pure investment which is 100% safe, secure, and better than everything else. What you will get is a solid investment that ticks the majority of your boxes, and if it fits your numbers and fits your criteria, then just go for it. Because, as I said, you can sometimes spend too much time looking at different options and then you don't do anything and you can miss out on properties. I know people that have been talking to me about investing in property for over 6 years. If they'd invested 6 years ago and whatever they were looking at the time, and they're not thinking, oh, I'm going to wait for the next one, oh, I've heard this is going to happen, or I heard the market's going to do this, so I'm going to wait for that opportunity, they probably would be in a lot better position now than they were now than they are if they had invested 6 years ago. So analysis paralysis is a risk as well. They're not doing anything.
Definitely. And I think not only, I mean, that's obviously a very extreme example that you mentioned there, but even just waiting 6 months, if you're talking about 150, 250,000 pound property and you're looking at the market growth of 6% per annum and a rental yield, just as an example of 6% net, then, there's a significant amount of capital that we're missing out on just from a 6-month wait. So, yes, to summarize, then going back through all of our points, you probably would have seen a theme there, but the theme is, or the heads up is, do your research. Don't rush into anything. Don't base an investment decision on a 15-minute conversation with a sales broker on a Thursday afternoon. Like, you have to sit down, get to your laptop, look at your spreadsheets, do your proper research, speak to local agents, speak to people that know what they're doing. But yeah, the long and short of it is, do some research and make sure you back up your investment decisions with the right data and knowledge there. So hopefully that's been really helpful.
Yeah, and we don't want to make it sound scary. I mean, obviously, this whole episode has been about the risks, so it is going to sound scary. But property investment isn't scary. We're just making it very clear that there is obviously risks involved. And as we mentioned, there's ways to reduce those risks. So again, that is something we can help with. Overall, property investments are a good, solid investment, especially over the long term. It is hard to go massively wrong if you're going for a standard, as we call vanilla / run of the mill investment, because over the long term they will perform well and you will make money. But it is just very important, as Nick says, you don't rush, you do your due diligence and you look into it fully before committing.
Yeah, absolutely. As long as you're doing your reading and supporting your investment decisions with the appropriate research, then you'll be absolutely fine. I mean, comparing it to other asset classes, the stock market is something I'm looking into myself a lot at the moment, looking at the performance of some of these index funds over the past sort of few years. It's incredibly volatile. The cryptocurrency, bits and bobs like that. If you're talking of investing tens of thousands of pounds in cash, then we want to make sure we're going for stable, low risk investment classes, which is exactly what property offers. So, yep, all done there. Good stuff. And do you want to let us know what we're looking at for next week then, Toby?
Yeah, next week, sort of following on from this, in some sense, we're going to be looking at how to choose an investment agency. So, as you all know, as our listeners, Track Capital here, we are a property investment agency where we help people choose investments and present them with investment opportunities. So, what we're going to talk about next week is how to choose an investment agency. So, we'll look at how they can help, what they should be doing, how they can add value, how they can assist you, and even sort of the questions that you should be asking them and what they should be providing to you as well in terms of level of service and what you should be looking for. So, yeah, a good one next week. I promise we're not just going to be singing our own praises. We will be really honest, and we're going to give you some good value on that as well, because, again, a lot of the investors we speak to, they will be speaking to other agencies. So it's good to know what you should be asking these companies, and that's including ourselves. I actually enjoy getting sort of interrogated and asked big questions, because it shows that an investor is thinking and looking into things fully. So it is appreciated when they do ask those questions. And again, as when I answer them, and I can answer them as best as possible, I'm hoping I can add value and give them an essence of confidence in the service and products we provide. So it'll be a good one next week. I'm looking forward to it, as always.
Excellent, excellent. Well, thanks for your time today, everyone. And hopefully that means we're all investing nice and safely and securely.
Exactly. So, as we mentioned, if you do want any advice in how you should be looking over those risks and how to be doing your research, please reach out to one of the members of the team, because we're always happy to help. But thank you for joining us this week, and we look forward to seeing you next week. Take care.
Thanks, everyone. Bye-bye.